Today's topic is Hyperliquid. And the way I wanted to kick off our guide on Hyperliquid is by actually taking a look at its product market fit. How did it solve certain problems within DeFi that actually helped it grow as much as it did? And then we're going to look at some of its core mechanisms, some of its innovations, and then we're going to do a hands-on walkthrough of the Hyperliquid dashboard so you can get familiar with it and understand what all the components are. I would mention that this video is probably aimed towards people who are not as familiar with Hyperliquid or might not be too familiar with trading as a whole in DeFi or just in general. So to start off with, let's look at what problems Hyperliquid actually solved within DeFi. So if we start off with what it looked like on Ethereum mainnet within DeFi and then compare that to centralized exchanges, the way that the DeFi apps would handle orders required more time because, as you know, in Ethereum mainnet, the goal is decentralization. And so pretty much every element of the transaction is going to require signatures. It's going to take time for it to get submitted to the blockchain, minted, included in a block, and that might result in too much price movement because orders are coming in non-stop. And by the time you fill an order, but by the time it executes, the price might just differ completely in 15 seconds. Since the point with trades is for them to be actually instant. So 10 seconds is a gigantic amount of time for any serious trader. So that was the first issue, is just the time it actually takes from the moment the order is submitted to the moment that the trade is actually successful. Compare that to a centralized exchange where an order comes in, the internal system auto updates, the matching engine finds the buyer and the seller, and there's fast, nearly instant execution. Sure, there's always going to be slippage based on the size of the order that happens, even on a centralized exchange, but the point is it happens fast, it happens instantly, so it actually minimizes the price movement, which is incredibly important for traders. So initially, DeFi had apps that used an automated market maker mechanism where traders interacted with a liquidity pool instead of matching it sort of peer-to-peer. And the issue there is that there's a lot of price movement when you're interacting with a pool instead of matching a buy and sell order. We have a video on how decentralized exchanges work that includes how these pools work. I recommend taking a look at that if you're not familiar with the concept of automated market makers and liquidity pools and how large swaps or trades can impact the price movement there. If that doesn't sound too familiar, check it out and come back to this video if you want to understand this problem area back in the days of pre-Hyperliquid exchanges. So you're interacting with an automated market maker, a liquidity pool that can result in slippage, in price movement, and again, it's not going to be instant. So a lot of downsides as compared to just using a centralized exchange. There were other apps like DYDX that had a centralized matching engine. So they took a large part of the order book off-chain so that they could actually handle a peer-to-peer system, simply because Ethereum at that time was not optimized to handle fast-moving order books fully on-chain. So it had to go off-chain. But then the issue was more of a philosophical nature as well, because it's like, do we want to interact with a decentralized platform, but this has such a huge element that's centralized, that's off-chain. So it became a legit question of why would you use a decentralized app when the UX is just so much worse compared to a centralized exchange for a trader? And that's where Hyperliquid came in and wanted to solve this problem. So what Hyperliquid does is that it's its own L1 blockchain. So Ethereum is its own L1 blockchain, Hyperliquid is its own L1 blockchain, and all of its mechanisms are aimed towards optimizing the trading experience. All of the backend of the blockchain is conceptualized to improve the trading experience, to improve how fast transactions can actually take place and happen, avoid having to do too many signatures, basically creating a setup where they can mirror a centralized exchange UX. You submit an order, you want to make a trade, you submit it, and it happens nearly instantly when you're matched with another buyer or a seller. And that's the idea. It uses a traditional order book system, which essentially is just matching a buyer with a seller. And then market makers are there to ensure that there's always liquidity, that there's always available orders, that buyers and sellers, when they come in and interact with the exchange, these orders can be filled. And the idea is that the validators on Hyperliquid have a consensus for the order book. So in this way, it's not a fully off-chain order book where, as we mentioned with DYDX, there might have been some concerns with something being so fully centralized, but here, validators actually can confirm that the trades happening are legit, essentially, through the order book. Now, we're going to go into the order book a bit more visually if you're not too familiar with this system when we do our hands-on walkthrough. So I'm not going to spend too much time talking about it. It's much more easier to follow it visually. So I do recommend staying on this video. A bit later on, we're going to be going hands-on with Hyperliquid. But the key points are that it matches the centralized exchange experience, but within DeFi. So we're talking about fast execution, low latency, tighter spreads, and that is optimal for traders because they need a large amount of liquidity. The market makers need to ensure that spreads are tight so that traders are incentivized to actually use the platform. And that's the main selling point, and that's the, I'd almost say, philosophy that helped it scale. It's a blockchain dedicated towards optimizing the trading experience instead of being an app on top of an already existing blockchain that might have to function within the constraints of that L1 blockchain's infrastructure. So it did make sense to go down the route of just making their very own blockchain. Now, I would also mention, if this is something you're interested in learning more about, we do have a video on how perps work within DeFi. So I do recommend having a look at that as well, because there we also cover some of the key mechanisms that you'll see on Hyperliquid, such as funding fees, for example, and just the general use case of perps and the mechanisms behind that. So moving on, one of the key innovations we want to look at for Hyperliquid is known as HIP3, Hyperliquid Improvement Proposal 3. This introduced permissionless perp markets. Essentially, anybody could come to Hyperliquid and submit to create their own perpetual market. Now, it's not fully permissionless in the sense that anyone can come in under any kind of rule and just make their own market. There's, of course, going to be liquidity requirements and other requirements to actually allow somebody to open up their own perpetual market. But the idea is that you already can see some certain, for example, commodities, not just crypto assets, but commodities can be traded on Hyperliquid, and those were added through the permissionless market creation system. So another element of DeFi entering a platform that's very close to sort of a centralized exchange UX. And then, of course, since it is an L1 blockchain, Hyperliquid has HyperEVM. That's essentially its own sort of Ethereum-style smart contracts that allow different DeFi apps to pop up within the Hyperliquid network, such as lending apps or DEXs or certain additional helping tools for traders. These can now all be built on top of Hyperliquid through HyperEVM. So these are some of the most key components of the blockchain. And I think it's going to be most useful if we go to a hands-on demo or walkthrough of the Hyperliquid dashboard, where we're going to sort of encapsulate what we've been talking about here and also discuss some other elements that might not be easy to follow along with if we're just talking about them in front of a whiteboard. So let's move on to that. All right, so I'm now on DeFi Saver, where I can go ahead and access Hyperliquid as one of the protocols in the dashboard. And the Hyperliquid dashboard here essentially gives you the same tools as you would find directly there, just with some other ones on top that don't exist on Hyperliquid when you're using it directly. So to start off with, if you haven't had experience with Hyperliquid before, we're going to go through the interface one by one to make sure you can understand everything that's going on. So the first thing to keep in mind, we're on Ethereum mainnet right now, but Hyperliquid is its own L1 blockchain, meaning that funds you have on Ethereum mainnet aren't going to work directly on Hyperliquid. We need to actually bridge them to Hyperliquid. So we're going to click this button that says funds. And from there, we have the option of actually depositing USDC. We can pick other coins as well, but let's do USDC. Let's bridge 100 from mainnet. We're going to be bridging it to Hyperliquid. Now, generally speaking, on Hyperliquid directly, it would require these funds to be on Arbitrum. But through DeFi Saver, you can start from mainnet, and it's going to use a bridging system to just get those funds from mainnet to Hyperliquid. We'll sign the bridging transaction. And there we go. So the funds were just bridged successfully from mainnet to Hyperliquid. And if we now look at the transfer tab, we'll see that we have 500 USDC on our spot balance that we can transfer to our perp balance. So that's something to keep in mind. On Hyperliquid, when you bridge funds there, they're going to be on your spot balance. And if you want to trade perps, you're going to have to transfer those funds from your spot balance to your perp balance. So we're going to do just that. Let's transfer 250 USDC. And we would click transfer. Now, there is an interesting thing you can do, which is what's written right here. And it says unified account is enabled. So that means that both your spot and your perp balances are unified and you don't have to switch between one another. This is a matter of personal preference. Some traders like to make sure that their funds for spot and perp trades are separate. Some just don't want to bother with it. They want all of that liquidity to be unified across both balances. So we now have a unified account. That means we can access these funds. And from the get-go, you can have different views here. We have trading, the portfolio of the user. This is going to contain information like P&L, our volume, what were the fees that were paid, the taker and the maker fees, and also the trade history itself. We can then move on to account management, which essentially lets you do a couple of things. So you can enable the unified account mode or disable it. You can also make sub-accounts. So for example, if you want to do different strategies on different accounts, you can fund them from one main account and then simply deploy funds to that sub-account and use it from there. Thing I would mention is that this is going to be separate balances from one account to another. And then here you can actually choose whether you want to be on a sub-account or the master or the main account. So if we go back to the trading view, I'm just going to also quickly cover the different UX elements. So here we can choose the market that we want to interact with. We have the option of selecting our favorite markets, which are going to show up in the starred markets tab. And we can also choose whether we want to have crypto assets, whether we want to trade TradFi assets or HIP3, which are, as we mentioned in the theoretical part, these are those permissionless markets that were added. And here you can see they were added by XYZ, which is a trading company that deployed this market. And these are commodities. So oil, silver, S&P 500, they're not crypto assets. And we can also just look at all of them and select the market we want to interact with. In this case, let's just do ETH USDC. One last thing I would mention is you can actually see what the leverage amount is for each of these markets and also the 8-hour funding fee right now. So you can figure out, okay, are shorts paying longs or are longs paying shorts? Also thinking, okay, if I want to go long on ETH, am I going to be paying funding fees or am I going to be earning if I go long at this point? So we see the current mark price and the current Oracle price. Why is there a mark price? Why is there an Oracle price? Well, the way to look at it is that the perp market itself has a lot of price action, a lot of orders coming in. And if it used the price from the perp market, that would be very influenced by price movement in large orders. They can skew the price a lot. So there would be room for price movement, maybe even price manipulation. So Hyperliquid and trading platforms need to have a fair price, basically. And this is going to be a price that's based on the current Oracle price and also an internal pricing mechanism. The idea is to just avoid market manipulation, have a price that's not manipulatable. And then the Oracle price is a price outside of Hyperliquid that is used for that asset. You can see the volume, the open interest, and that's just the amount of liquidity in the short and long perp positions. And we can also see the current funding fee as well as when is the next funding fee update. Next up here, we can see the leverage amount. So ETH has a 25 times leverage amount. For our example, I mean, let's just go with 10 times. And here we have the margin mode. Margin is your collateral. So imagine if you have 100 USDC that you want to trade with, your margin is 100 USDC. And then, for example, if you want to leverage it 10 times, that means your position is going to be up to 1,000 USDC of exposure, but your margin is going to be 100 USDC. And so what does isolated versus cross margin mode mean? Well, on isolated margin mode, it means that this perp position is only going to be able to work with the margin you give it. So if I go here now, I say isolated, and I want to, for example, put 100 USDC as my margin, and I'm going to leverage it 10 times. So I'm going to be at, say, 1,000 USDC. Let's put this much. So now, as you can see here, it's going to say that the margin required is 106 USDC. Since my position is worth 1,000 USDC and I put 10 times leverage, my actual collateral is 106 USDC. Meaning if my position's value drops under this amount, I lose this much, I'm going to get liquidated, even before I lose this exact amount. So with isolated margin, that's it. This position, this is all the margin this position can work with. If it's cross margin, then it's actually going to be able to use all the liquidity available, all the margin I have available across different positions as well. And that might be useful if you want to keep your position safer from liquidation. The only issue is that that can also drain your account if the price keeps moving against you. So isolated, just imagine it like keeping all the funds concentrated and I'd say isolated within this one perp, and cross lets you use liquidity across all of your existing perp positions so they can fund one another, essentially. Maybe one is positive so that you can use the positive from one trade to fund liquidation protection on another one. So we have that finished. We can look at the chart real quickly. I would assume that you're familiar with how charts work. If you're not, these green candles represent the price movement of the asset in the past time frame that you input here. So as you can see, you can do 1 minute, 5 minutes, 15 minutes, 1 hour, 4 days, 4 hours a day. Right now we're on an hour candle. And so these are known as candles. They represent what the price of ETH was like at the previous hours from this current moment. And they include, as you can see here, the open, the high, the low, and the close price. So at the start of the hour, what price did ETH open at? What price did it close at? What's the highest price it reached? What's the lowest price it reached? And as you can see here, there's these thinner lines, these bolder lines. The thinner lines are known as wicks, and they actually represent the lowest or the highest price it reached. So not the open and close price, but the lowest and highest price. So as you can see here, this wick represents that its lowest price was at 21.13, and this wick here represents that its highest price was at 21.36. And that's the way to look at it. They just represent the price movement. If it's green, it means it closed higher than the previous one. If it's red, it closed lower than the previous candle. And as you can see here, there's huge wicks, but the candle itself, the bold part is very small. So that means there wasn't actually a lot of price movement when it came to open and close prices compared to the previous candle. Moving on, we have our order book and the previous trades. So the way the order book works is it shows you all the current orders that are being put up in the order book that say, okay, so this side wants to sell ETH at this price, this side wants to buy ETH at this price, and this is the spread or the difference between these two prices. You can see the amount of orders at each price range. So think of it this way as well. When somebody wants to enter a trade, if it's a huge trade, so we can see the amount of ETH that's actually around this price range. And if somebody wanted to maybe buy, I don't know, 2,000 ETH, well, it's going to fill these orders, these, and these as well. So it's going to fill in all of these price ranges. Because you can see here, the total amount up to this point is like 2,000 ETH. So it's going to fill in all of these orders. It's not going to get just one price. It's going to get all of these prices, and there's going to be slippage there. And so that's what we were talking about with market impact the price impact, the slippage that you experience, that's what can happen with large trades. It can fill in all of these orders very quickly and you get a bad price. So how do you avoid that? We're going to look at the different order types. So here we have a basic market order. What that means is you want to buy maybe long ETH at the current market price. So there's no waiting time. You just want to jump into the market right now. So I just established my connection. I'm now going to just take a look at here. I can see the fees that I'm going to be paying, the liquidation price, the order value, and what my margin is going to be. I create the order. I see all of these details here again, and I confirm it. Once I've confirmed it, that order is going to be showing up under positions. And from here, we're going to look at some other tools you have available, but let's quickly go back here. Let's just look at what other order types there are. So ways to actually enter a position. There's limit orders, which are they're pretty much the same concept as classic limit orders in exchanges. When you're swapping, you just say, hey, I want to place an order where I'm going to be entering a leveraged position, going long on ETH, but once ETH's price reaches the threshold I input, so like 2200, for example, or pardon me, I'm going long, so maybe I want to enter at a lower price, so 2100. That's where I want to enter my long position. And then when I create the order, it's going to show up on the order book. That's something to keep in mind. Limit orders show up in the order book as an order that's waiting to get filled. Why do I say this? Because next we're looking at conditional orders, which are kind of the same thing as limit orders. You can see that we can do the same kind of thing with it. But what we can also do here is ensure that it's not a live order. So if I say, for example, back then I said 2100 ETH, that's my limit order. It's going to enter the order book immediately. With conditional orders, we're going to input the trigger price. So once ETH's price reaches maybe 2120, that's when I want you to make a limit order for 2100. So that basically just keeps your order outside of the public order book until a certain trigger point is hit. Next up, we have scale orders, which is how you can maybe mitigate some slippage, because scale orders let you say, okay, I want to enter along on ETH, but I want to enter it slowly from 2150 to 2200, and that I want to split it across 10 different orders. So it's going to perform 10 similar orders at these price ranges, and that's how we're going to be entering our position. And that's how we're going to be also avoiding slippage, because we're not just going to open one big trade that's going to cause a lot of market impact and a lot of these orders to be filled. We're going to fill them one by one, bit by bit, through this price range. And then time in force essentially means how the order is going to get filled. So this one means that it's going to get filled essentially immediately. As soon as it's available, I want to enter it. IOC means that you're going to fill the order only in case of the order getting filled. Otherwise, if there's any leftover liquidity, cancel it. So think of it this way. If you have an order where maybe at this point you have 10 ETH that you want to trade with, only 6 ETH can be filled currently with the order. That 4 ETH, don't keep it within the strategy, just cancel the order entirely. I don't want it to go in, maybe it's going to be a different price. I don't want that. If only 6 ETH can be filled out of my 10 now, fill in the 6 ETH, the other 4, cancel it. And then this means add liquidity only. You only want to add it if it's going to show up as an order in the order book. You're going to be adding liquidity to the order book. It's not going to get filled instantly. And those are the differences. But I would say that somebody just entering trading is going to just keep this option as default. Skew just means, do you want to differentiate the order sizes from beginning of the price range to the end? So positive skewing means that there's going to be a larger buy amount closer to the start range. And if you put a minus there, there's going to be a larger buy amount at the bottom or the end of the price range. So just different ways to, I wouldn't say randomize your order of buying, but to give it a bit of variety. Now we're going to jump into TWAP, or time weighted average price. The idea here is that with scale orders, we were doing a price range. Here we're doing a time frame. So you're inputting, for example, whichever trade you want to make, whichever size you want to do it with. So you say 1300 is the position size, and we want to fill it over 30 minutes. And so this means that, well, let me just increase the price amount, let's say 2600. So I want to enter this trade, but I want to enter it over, let's say, an hour worth of time. And then I'm just going to increase my margin here. Actually, let's put it back to just 30 minutes so I can fill in the order. Okay, so I want to enter this trade over 30 minutes. And I'm actually going to be able to see that over 30 minutes, there's going to be 61 orders every 30 seconds. That's going to help me enter this trade. Now, aside from just avoiding slippage, this is a way that large traders try and kind of mask their trades. They don't want to get front run by some trades, and they might not just want to communicate a large trade they're going to be making to the order book. So what they can also do is tick randomize. So this, instead of just doing 30-second increments every single time, it's actually going to just randomize at which intervals the order is going to start getting filled. So avoiding slippage and kind of masking the trade itself. That's what TWAP is. And then we also have trailing. Now this is a DeFi Saver exclusive way of opening a trade on Hyperliquid. And what trailing orders do is they let you set a percentage, for example, by which the price should differ. So for example, let's look at what it says here. So activates, ETH price drops by 5% from the highest price since order placement. If we go to rise, it says ETH price rises by 5% from the lowest price since the placement of the order. So what does this actually mean? Why would somebody use trailing orders to enter a position? Well, think of it this way. For example, your trading strategy might be to enter when the asset's price starts falling, but there's an indicator that its price is going to start rising up. And so maybe your indicator is that it starts to fall, it reaches a low, but then it increases by 5%. So that for you means I want to enter. I think now the price is going to reverse and go up. So I want to go long. Fall means, okay, maybe you want to catch an upward trend. So for example, for you, if ETH's price starts increasing, that's a sign for you that you want to enter the market. But you need sort of a sign that you didn't miss out on the top. So the price starts increasing a bit, it falls by 5%, you want to enter there since you think now there's going to be bullish movement and the price is going to keep going up until it sort of plateaus, it reaches the local top, and then it starts falling. So that's trailing orders and what they do. We've now covered all of the ways to open a trade. Let's now just quickly look at actually closing a trade. So you can share the P&L of a position. You can do a market close, which just means close it at the current market price. That's it. You can also do market close, limit close, TWAP close, scale close, which are essentially the same exact thing we just talked about with orders, just closing them, but with the same kind of strategy. Reverse just means, okay, if I'm long, go short, straight up. Here, I can also set up a take profit and stop loss after I've opened the position, even though I can also do it or before I actually open it by clicking right here. And I can also set up a trailing stop loss. Again, similar in concept to trailing orders. So you want to say, I want to lock in some of my gains. So I want to say, hey, if ETH's price starts moving up, when it starts falling a certain percentage from its price increase, that's when I want to close the position. So it's like, instead of just saying take profit at, right now it's 21.37, instead of me just saying, okay, I want to take profit and close my position at 2200, what if its price keeps going up without actually falling down? I want to protect myself from that. I want to make sure I earn as much as possible. So maybe I say, okay, I want to do a 5% difference. So when there's a 5% fall in ETH's price from its high, that's when my position is going to be closed. So what if it keeps going? It never falls more than 5%. Even after 2,200, it reaches 2,300, and then it falls by 5%, and then my position is closed. So I've earned more than just a stop loss, or rather a take profit that's going to close it at a flat price. And of course, here we can see our P&L and all the basic information about our position. And that wraps up the introduction to Hyperliquid, a hands-on guide. I didn't want to go too much into detail, but I also did want to cover every aspect of the dashboard. Make sure you're familiar with the bridging, spot, perp balances, how charts work, function, and how different order types work, what purpose do they serve. So hopefully after this guide, you're going to be feeling much more comfortable opening up a position of Hyperliquid and potentially trading on it.